Hi everyone, my name is Ronaldo. Welcome to Sterling Digest. Today I'm with my colleague Davis Kabenji, a research analyst at Sterling Capital. Just a recap, if you're new to this channel, in the first episode we discussed the macroeconomic performance in the first half of the year. In the second episode we discussed the performance of the banking sector and gave an outlook. In the third, we're just going to conclude the performance of the banking sector and its outlook, cover a bit of Safaricom ahead of the results release or first half results release later this month, later in November, and we're also going to discuss national accounts in the first quarter of the 2023-24 fiscal year. So, Davis, 9 months of the calendar year passed. What is your view on the performance of the banking sector in the first half, and also the 3 months that will conclude the year?
Yeah. So banks are generally doing well, but for the last quarter of the year, we expect them to ramp up provisions quite a bit. As you've seen, NPLs, non-performing loans, have been shooting up quite significantly. The industry average is at 15%, which is a historic high, if you will. And so, in light of that, a number of banks such as Corp Bank, NCBA, KCB, and subsequently this quarter, we expect DTP to ramp up their provisions quite a bit. So, as they do that, that means that their profits are likely to be quite flat on a year-on-year basis. Dividends also likely to be quite flat. KCB may then end up reducing its dividends because it needs to recapitalize some of its subsidiaries. So banking sector for those particular banks largely flat. However, for banks such as ABSA, Standard Chartered, give or take some legal issues that they have, just in case they take provisions for that. Assuming that they don't take provisions for that, the profits on Standard will grow quite a bit, double digits, same for ABSA as well as for EP.3. But for the rest of the banks, largely flat, just because of how much they need to increase the level of provisioning. And in light of that, as well as interest rates on bonds going up, that means that share prices will continue either being flat or going down. So we expect that trend to continue through full year.
You mentioned something interesting about KCB. You're saying there's a possibility of a decline in dividend. Do you see any other banks? Because that means a lot in terms of investment income. So investors will be worried about banks that are likely to report a decline in dividends.
Yeah. So for KCB, they do need to do this. They need to raise their tier 2 capital. So they need to, for NBK as well as KCB Kenya, they are really undercapitalized. They need to raise tier 2 and may raise even tier 1. Because of just how their capital ratios are, dividends are likely to be reduced. Now, the other thing that we mentioned is maybe Stanchart. If you notice recently, there's a particular court case that's been going on for a very long time, just due to their pension structure with employees and the like. Now, recently, I believe the case reached the High Court, should be now going to the Court of Appeal. So at the High Court level, those employees were given an award of 30 billion shillings. That's 2 years worth of Standard Chartered profits as a whole. So if things go badly for them, like what Standard Chartered tends to do is that they preemptively increase provisions. So if they do preemptively increase provisions, that will signal to the market that they view this as a material event that may materialize, and hence dividends may be suspended for 2 years. But if you see the dividends just trend being the same, because they announced dividends in Q3 for interim and then for year, that means that they don't expect this to materialize, and hence things should be, they'll maintain the dividend policy or increase it, just considering how much they're growing in the payout between 70 and 80% of their profits. So these are just the things to be mindful of. If they don't pay a dividend, of course, given that people only invest in this stock for that particular reason, the sell-off will be quite significant.
Okay, thank you for that. KCB last week we saw the share price at about 19 shillings. Earlier this year we saw it at say close to 40 shillings.
Yeah.
The question investors are asking is how low can it go? Do you think it has bottomed out? It's going to start rising?
Okay. So for KCB, it's hard to tell, but it's unlikely that this is the bottom. In fact, if they were to raise tier one capital, that means maybe they'd have a rights issue. So if there was something of a rights issue that would be had, of course, rights issues whereby you're given the right to buy shares within that company at a much lower price. So there'd be a huge sell-off in terms of the shares. So if the issues continue into the full year, and then we hear that they need to do something like a rights issue to raise their own capital, the share price will continue going down, unfortunately. And with the present issues and the low dividend, there's little incentive to invest in the company. For institutional funds, it makes more money. It makes more sense to invest in bonds. Actually, the more interest rates rise, the more stock valuations will continue coming down. KCP will experience that materially higher, just given the nature of the company, the fact it's a blue chip, similar to Safaricom.
Just you have mentioned interest rates. Let me diverge a bit. There's an IFB, there's an infrastructure bond, 6.5, 6.5 year infrastructure bond that's up for sale. Interest rates have been rising. When you look at the market players, some are saying the interest rates could be between 16 and 18%, which is significantly high considering it starts through.
Yeah.
With regards to interest rates, do you think we still have an upside to interest rates, or are we near the peak?
Yeah. So I believe as we touch on national accounts, we'll see this more, but because of how the fiscal deficit is, so fiscal deficit is whereby expenditure exceeds revenue for the government and hence the need to borrow. The fact that the government is pegging them meeting their targets on revenue increases that are not feasible, that means that the domestic borrowing targets will continue going up. Now, if those domestic borrowing targets are going up, the market knows that, okay, the government is desperate for money, so we'll just keep on peaking higher and higher. So interest rates will continue rising for quite a while, at least through 2024, in my opinion. It's hard to foresee a scenario where they come down unless the fiscal situation is resolved such that they reduce expenditure, that's current expenditure in particular, and then their revenue forecasts are more realistic, not as optimistic as they are. So in light of that, interest rates will continue rising quite a bit, and the more interest rates rise, stocks have to give a higher return than bonds. So people will sell off their stocks to buy bonds because it makes more sense. Actually, this IFB, if you open an account recently with the CPK, you notice how fast they're opening them. Like they open them immediately, you start getting a lot of texts. There's an IFB going on, and the retail have been selling stocks to buy bonds. So that's just going to be the trend at least through next year.
Now, I thought we were going to discuss Safaricom, but since you mentioned national accounts, let's put some numbers to it. The first quarter of the fiscal year has ended. The government has raised about 514 billion shillings through tax income, which is about 21% of the fiscal year's target. In terms of total revenue, about 20% collected. Been 3 months, if you look at a linear run rate, we're looking at about 25%. This means a deficit of about 109 billion shillings. If we continue on this trend, we're going to see close to about an additional deficit of about 300 billion, which pushes the total year's deficit to slightly under 1 trillion shillings. Do you think this is a possibility, or do you expect an increase in tax revenue income?
So I believe that similar to what you're saying, our targets, the fiscal deficit will hit a trillion. That's basically the reality on the ground, or somewhere near that about, unless they reduce their targets on expenditure. Otherwise, those targets are not going to be hit. As a function of that, domestic borrowing will go up, interest rates will continue going up. The situation that we have at present will just continue as is going forward. It's not sustainable, and eventually we're going to see the effects of it trickling through the entire economy.
The trend we have seen is the government cutting down on development expenditure. We saw that the last 2 fiscal years. In terms of expenditure, we see pressure from the counties for the government to transfer cash to the counties just to meet their own recurrent expenditures. But the easiest in terms of adjusting is normally the development expenditure. So, in terms of development expenditure, the government has so far just spent 6% of its annual target. So you can see this trend.
Yeah.
Do you think this is going to be the trend going forward, or do you see also room to reduce recurrent expenditure?
So unfortunately, with what the government communicates is that they need something called, okay, something that us we struggle to understand, but something called political capital, whereby you need to keep the people in your team comfortable, if you will. So unfortunately, because of that trend, that means that recurrent expenditure won't come down, but development expenditure will continue coming down because it's the easiest to just cut and sort of move on. We just hope we never get to a point where by now you can't even reduce development expenditure or development expenditure itself is at zero. That will be in the long run, dire for the economy, because all the infrastructure will just remain as it is, or wear and tear, and you kind of need to be replacing it. Yeah.
So let me ask you maybe what would be a very difficult question in terms of assume this you're the central bank or the government, you have to find a balance between managing the cost of debt and also meeting your borrowing needs. What would you do? Because now we're looking at it in terms of the government has a deficit of say 718 billion to fill, and they also want to manage the cost of borrowing, keep interest rates low. But the market demands high interest rates, probably because of the risk, and also the perception that the government is desperate for funds to fill this deficit. So, how would you manage the cost of borrowing yet meet your deficit financing needs?
Yeah. Okay, so mine is a bit extreme because as of just make a decision now and then because kicking the can down the road it will affect us badly later on. So mine would be you need to zero development expenditure for one fiscal year because that's our entire deficit. It actually almost entirely fit into that. If you reduce it in that particular way, and then now again this is hypothetical, and then now for a few months just stop bonds altogether, like bonds, T-bills, and the like because assuming your revenues should be almost meeting your particular borrowing, your targets, if you will.
Let me stop you there because, okay, you might want to stop borrowing additional funds, but also remember that a big proportion of borrowing is going to meet current or to meet redemptions. That is money that was borrowed in the past. How would you manage that by not borrowing? Because you have I would say if you look at every auction, there's a significant portion of new borrowing that goes to meeting redemptions.
Yeah. So again, this is a stopgap measure. So you zero it and then you stop borrowing at least for a month or two. That way, you signal to the market that you don't necessarily need their money. So in that way, you issue a very long-term bond, like a 25-year bond, at either a predetermined rate. Before you used to see like let's say IFPs, they'd actually tell you the rate of that particular IFP, if it's 9%, 12%, etc. So you issue a very long-term bond, and since you're signaling to the market that we don't necessarily need your particular fund because you've reduced development expenditure to this extreme, in that way you're refinancing at a very long term at very low interest rates. At least that's how I'd think through it.
So, if you look at it in terms of government borrowing, you're saying even in terms of treasury bills, you have say 90% of subscriptions going to the 91 day, very low subscriptions for the 182 and 364 day, which means that there's less demand for longer term debt because investors expect interest rates to go up.
Yeah.
Do you think there's going to be demand for a 25-year bond when you can't raise demand for, say, a 182 or 364 day treasury bill? Or do you think also the government should give what the market finds attractive? Perhaps now just go on a trend of issuing infrastructure bonds or 2-year, or even we saw less demand for 2-year and 5-year bonds because the market saturated with this term 10-year bonds.
Yeah. So again, this would be a scenario whereby you're effectively reducing development expenditure to almost being nothing. And then you're not issuing new debt for a very short period of time to just signal to the market. Remember, pension funds and the like, they actually need to be investing in securities. Now, if you, it's like when Kibaki was around, if you don't issue this long term or rather debt as a whole, this will force people to actually go look for yield elsewhere. And that means that if you keep it for a short period of time, let's say 3 months, and tell people, okay, we're not looking for any debt for this particular period because we've zeroed this development expenditure. And then you come back 3 months later and say, okay, we issue this 25-year bond, this is the tenor, you take it or leave it. Because again, because of that stopgap measure that we've put in, development expenditure at zero, you don't necessarily need your money. The market will actually run to this because they need yield either way, because finances keep on coming in. You'll have asset liability mismatches if you don't keep on investing the money that's coming into pensions and money market funds. So again, this is just a hypothetical way I think through it.
Yeah. Now, I don't think I agree with you, but that's your view. Now, the other thing is the government's the biggest, one of the biggest drivers of economic growth. You cut down on development expenditure, they're now you're constrained or it reduced the government spending. So that could have a negative impact on economic growth. So what would be your view on how the government can still spur economic activity but reduce their spending?
So a hard decision. I'm of the view that a hard decision has to be made now, because just think about it. If this next bond comes out, let's say similar to the other IFP that was done, they do, let's say, 200 billion. In my opinion, it may even do more. So if they do that amount and then they're doing it at an interest rate of, again, hypothetically, between 16 and 18%, let's say we do 17. So you're looking at interest payments of 34 billion each and every year. You know, that's not sustainable. And then when it comes to redemption, even the way its bonds are amortized, you'll be amortizing at almost 100 billion at those particular years that it's supposed to be. You're paying off the principal partially. So if this trend continues of, let's say, issuing IFPs, while attractive to the market, it's not sustainable. At one point or another, you may actually enter into a default. You need to refinance at very long rates. The only way to do that is to signal that you don't actually need the market. At least that's my view. Now, as far as economic growth is concerned, we've been feeling growth, like you're borrowing and then spending on expenditure whose ROI, on infrastructure whose ROI spikes low, rather than giving it, let's say, to the private sector. So I believe the private sector should drive growth on the whole. Like the government, our GDP can't be growing on the basis of just government spending. This would be the real economy that's actually driving this particular growth, and the real economy is quite strained. So, in the long haul, though you shouldn't do this immediately, the business environment should just be better. More favorable tax regimes, like excise tax on sin, or rather sin taxes, have gone up by almost 30%. So VAT bills revenue is coming under heavy pressure, and that currency depreciation is just creating a difficult business environment. So to spur that better, rather than increasing taxes as we have been, we actually need to reduce expenditure, particularly recurrent, and make it more favorable. That way, businesses increase in volumes. Like Safaricom, because of how much volumes have been increasing, and better ways, they can reduce transaction charges. That's the most ideal scenario. So volumes go up, and then you can reduce taxes. So that's how we get more organic growth rather than the situation we find ourselves in now.
Thanks for that. Maybe that's it with national accounts. Maybe we can move on to Safaricom. 6 months, the financial year starts in April, and the first half ends end of September. On 9th November, they release the half year results. Yeah. What would you expect? What do you expect in terms of the performance?
Yeah. So I'll start maybe with the full year, because half year will have a lot of nuances. So for full year, the revenues will go up, of course. They'll do over 300 billion in revenues. Now, as we come down the P&L, the main issue that you have is that they'll announce the biggest loss ever, at least as per the opinion, in Ethiopia. So Ethiopia at least per our models and forecasts, we're expecting a loss of at least 32 billion. Now, the difficulty with projecting at least how half year is looking is on the basis of we don't know when they'll take majority of the loss, whether it will be in the first half of the year or the second, and also the hyperinflationary gains. So, because Ethiopia is in a hyperinflationary environment, the way international accounting standards are is that you have a monetary gain on translation. At the group level, even if they're earning in Ethiopian birr, they need to consolidate in shillings and the like. So, because of an accounting basis, they actually end up getting a gain. That's what happened last year. So, what that means is it's hard to really boil down how that's the hyperinflationary monetary adjustment we've made, as well as when they'll announce which half of the year they'll announce the biggest loss or not. As per management, in half year they may announce a gain at the after-tax profit level, maybe due to the hyperinflationary monetary gain. But on the whole, we expect that profits should come down between 10 and 15%, just on the basis of the loss in Ethiopia. Key drivers of growth now in Kenya will be M-Pesa, of course. There's some weakness in voice and messaging that's just been happening for very many years and will continue because you have other alternatives such as WhatsApp.
And also, just to mention voice, also the pressure on mobile termination.
Yeah, actually, we were supposed to get the CA, what Communications Authority new rate. So it's 58 cents now, but it may drop because in the world ours are almost like the highest. They should really be coming down similar to global standards. But Safaricom argues that it will disincentivize them from putting up infrastructure. But ultimately, they will come down. So pressure will just continue those lines. So and then now, so ideally, Safaricom is supposed to be, I believe, creating low-cost mobile phones. So being incentivized to do so such that as much as they're losing customers as far as revenue, voice revenues being lost, these customers are going to data because guys are getting 4G devices and the like. But now because of how taxes have been going up, they're losing interest. Like people can't afford to buy those phones.
Yes.
Unfortunately. So,
but we still expect more mobile data growth and possibly also fixed data revenue to grow.
Yeah, so those would still go up. At least that's for the Kenyan unit. For Ethiopia, revenues as per forecast will come in around 5 billion shillings, thereabout. Losses will be quite huge, again, around 32 billion, thereabout, just because of the cost of investment. Break even at EBITDA, not bottom line for Ethiopia, is fully at 26, so it will take some time. And of course, all this means that the share price will come under heavy pressure. Because even at a fundamental basis, when you make adjustments to your model, it's hard to justify buying it at too high a price. And then now, with how high interest rates are locally and globally, people would rather sell off than wait 3 to 5 years for it to recover. But otherwise, if you have a long investment period and you're not afraid of all the market news, negativity, it's a really good stock to buy. At 13, it's at a 9 or 10-year low. It's quite attractive. So, yeah, these are the numbers.
So a recurring theme in all these discussions, whether it's banking or Safaricom, macroeconomic variables, especially inflation, foreign exchange. So these are things maybe in our next episode we should discuss state of the economy. Yeah, that would be a good theme in the next Sterling Digest session. So that I guess that takes us to the conclusion of this week's edition. Unless you have anything to say.
Yeah, maybe just to ask you, if you're the CBK governor in government, what should you do?
Good question. I think my view is different from yours. For now, I would focus because a lot of things are also out of my hand. When I was looking at the proportion of money or of current expenditure being spent on public debt, it's close to 90% of the current expenditure is on public debt, which means that it's a significant proportion of our tax revenue is going to meet our debt obligations. So my focus would be on ensuring that we meet our obligations because any default would have an adverse effect on the economy. So for now, like you say, kicking the can down the road, I think that is what we need to do at least in the short term. But in the long term, we need to also look at ways we can, for the sustainability of the economy, reduce the budget deficit. I know it's painful to increase taxes, but that's probably one of the easiest ways to reduce the budget deficit. I think our room for reducing the current expenditure is minimal, considering that a big proportion of it is in meeting debt obligations. Uh, I think the government, as much as it's not ideal, reducing development expenditure is the right path, but we still need some extent, at least some development expenditure to spawn the economy, especially an economy that is, I would say, not operating to the potential of in its full potential. So that's what I would do. So I think there's some good decisions the government is making, or the national treasury. There's some bad decisions in terms of I don't think they're doing enough to reduce the recurrent or discretionary recurrent expenditure. So that's the route that I would take if I was the government was in that position.
Yeah, we don't envy those in that position.
Yes. In our next episode, it will be good to discuss the state of the economy,
Yeah.
with particular focus on interest rates, public debt, and foreign exchange. So that's the end of this episode. Please remember to follow us on our YouTube channel, Sterling Digest.